We are currently standing at a defining historical juncture, not just for the silver market, but for the entire global financial system. On this day, January 1, 2026, the silver market finds itself characterized by a violent decoupling of paper derivatives from physical realities and a geopolitical restructuring of supply chains. If you are looking at your trading screens today and seeing silver prices hovering precariously in the low $70 range, you aren't looking at the real market. You are looking at a paper derivative illusion that has been systematically severed from the physical truth. The era of silver being treated as a mere monetary hedge is over. We have officially transitioned into a new era where silver is a strategic industrial imperative, and the developments we are witnessing today have made the move toward triple-digit silver a mathematical certainty. My name is Kevin Huang, and this is Markets in Context. Today is January 1, 2026. And as the global markets initiate this new trading year, we are witnessing a geopolitical restructuring of supply chains that will change everything you thought you knew about precious metals. Before we break down the granular data that the Western exchanges are trying to hide behind a veil of holiday illiquidity, make sure you hit that subscribe button and turn on the notification bell. We are entering a period of extreme structural stress, and you cannot afford to be blinded by the paper price as the physical supply vanishes in real time. To understand why we are on the verge of a historic explosion, we have to look at the scoreboard we just left behind. The preceding year, 2025, concluded with silver delivering returns exceeding 140%, vastly outperforming gold, equities, and traditional commodities. This performance was driven by a perfect storm of widening supply deficits, the accelerating adoption of silver-intensive solar technologies like TOPCon and HJT, and the burgeoning infrastructure demands of the artificial intelligence sector. For perspective, silver began 2025 trading near $28 to $30 per ounce. The close of $71.26 represents a fundamental and permanent repricing of the metal. Silver concluded 2025 with an annual gain of approximately 141.28% to 150%, cementing its status as the top performing major asset class of the year. However, as we open the 2026 trading year, the atmosphere is anything but tranquil. While holiday closures have dampened volumes in Asian and European trading hours, the price action leading into and including the January 1 open reveals a market under extreme stress. The narrative is one of two distinct markets: the highly leveraged, regulated futures market in the West and the supply-constrained, premium-heavy physical market in the East. If you were watching the charts in the closing hours of 2025, you witnessed a dramatic liquidation event, often referred to by traders as a flash crash, which has set a volatile tone for the opening of 2026. As of the close of trading on December 31, 2025, and into the electronic trading sessions of January 1, silver prices experienced a sharp corrective move. The metal ended the year at approximately $71.26 to $71.29 per ounce. This represents a single-day decline of roughly 6.49% to 6.81% from the previous session. The intraday volatility preceding this close was significant, with a daily high between $76.51 and $76.70, and a daily low between $70.06 and $70.45. This intraday range of over $6 per ounce indicates a market struggling to find equilibrium amidst thin liquidity and aggressive margin calls. The technical breakdown on New Year's Eve was particularly aggressive. The precipitous drop forced the price below the 9-day exponential moving average of $71.54. This level now acts as immediate resistance. The next critical support zone lies at the psychological and structural barrier of $70 exactly, which coincides with the lower boundary of the long-term ascending channel. A sustained break below this level could trigger algorithmic selling targeting the 50-day exponential moving average near $59.32. though fundamental buyers are expected to emerge well before that depth. On December 29, 2025, the market actually hit a record high of $83.64 before being violently slammed back down. It is essential to recognize that this violent price action was not driven by a sudden collapse in industrial demand or a newly discovered silver deposit. Instead, it was a classic market structure event triggered by regulatory intervention and exacerbated by holiday illiquidity. The primary catalyst for the sell-off was the decision by the CME Group, the operator of the COMEX Futures Exchange, to raise margin requirements. Effective December 29, 2025, the initial margin requirement for Benchmark's 5,000-ounce silver futures contracts was increased to $25,000 per contract. This represents a significant increase aimed at curbing volatility. For leveraged traders, particularly those who entered positions late in the rally near the $80 level, this hike necessitated the immediate deposit of additional capital. Those unable to meet the call were forced to liquidate positions at market creating a cascade of sell orders. It is crucial to distinguish that this selling pressure occurred in the paper market. There is no evidence of physical destocking. In fact, physical accumulation has accelerated during this price dip. The 13.6% margin hike served as a brake on speculative excess, but did not alter the underlying supply-demand deficit. While Western markets fixated on the COMEX correction, the physical market in China told a starkly different story. Closing data from December 31 reveals a market in a state of acute shortage. The Shanghai Gold Exchange provides the most transparent window into this physical industrial demand. The deferred settlement AG-TSD contract, which is the benchmark for liquidity, closed at 17,059 RMB per kilogram. However, the AG 99.99 contract, for 99.99% pure silver essential for solar paste and electronics, closed significantly higher at 18,700 RMB per kilogram. To understand the magnitude of this dislocation, we must convert these prices into USD per troy ounce using the exchange rate of approximately 7.15. The AG-TSD conversion results in approximately $74.21 per ounce. More shockingly, the AG 99.99 conversion brings us to a price of approximately $81.35 per ounce. Comparing these figures to the international spot close of roughly $71.26, the AG-TSD contract traded at a premium of approximately $2.95 per ounce. More incredibly, the AG 99.99 contract traded at a massive premium of roughly $10.09 per ounce. This premium, ranging from $3 to over $10 depending on purity, is a screaming signal of physical scarcity within China. Historically, arbitrageurs would buy silver in London or New York and ship it to Shanghai to capture this spread, normalizing prices. However, as of January 1, 2026, new export controls and logistical bottlenecks have severely impaired this arbitrage mechanism. The China price is becoming the de facto price for industrial users, while the world price reflects paper speculation. Adding to the complexity is the performance of the Chinese yuan. Throughout 2025, the yuan was a top performer among Asian currencies, gaining over 4% against the US dollar. This strength is underpinned by China's steady monetary policy relative to the anticipated easing by the Federal Reserve. A stronger yuan makes dollar-denominated silver cheaper for Chinese importers, theoretically boosting their purchasing power. However, with domestic premiums so high, the currency advantage is overshadowed by the sheer lack of physical metal availability. The most consequential news event of the day is the formal enactment of China's silver export licensing system. This policy shift represents the structural weaponization of silver, aligning it with other strategic resources like rare earths, tungsten, and antimony. Effective January 1, 2026, the Ministry of Commerce has replaced the previous export management system with a rigorous licensing regime. Every shipment of silver exiting mainland China now requires a specific government-issued license, replacing the broader volume-based quota system that allowed for more fluid movement of metal. This introduces approval friction. Beijing now possesses a kill switch for silver exports. If domestic solar manufacturers face a shortage, the ministry can simply pause the issuance of licenses, trapping metal within the country regardless of international prices. This effectively transforms Chinese silver supply from a global resource into a domestic strategic reserve. While official communiques cite resource protection and national security, the timing coincides with the explosion in silver demand for TOPCon solar cells and AI hardware, suggesting a mercantilist strategy. By securing low-cost silver for its own manufacturers while starving international competitors, China aims to cement its dominance in green energy and high-tech manufacturing. On December 30, 2025, the Ministry of Commerce released the definitive list of entities authorized to export silver for the 2026 to 2027 period. The list is restricted to 44 companies, an increase of only 2 from the previous year, despite the booming market. This consolidation of power is dominated by large, state-owned enterprises and major mining conglomerates. Smaller trading houses and independent arbitrageurs have been effectively excluded. International buyers can no longer source silver from a diverse array of Chinese suppliers. They must negotiate with this cartel of 44 state-approved entities, giving Beijing immense leverage over pricing and availability. One of the largest integrated producers on this list is Jiangxi Copper, whose internal compliance documents indicate strict adherence to state directives. Another global giant, Zijin Mining, acts as a primary conduit for Chinese metal to the world. Yunnan Copper and Tongling Non-Ferrous Metals Group are also major state-linked producers, designated as gatekeepers. Bayan Non-Ferrous Group rounds out this critical group, reinforcing the state's grip on the metal's flow. This policy utilizes export licenses and a white list of approved exporters to control flow and favor domestic industry. Unlike rare earths, silver is a monetary asset. Restricting its flow impacts global financial liquidity, not just industrial supply chains. The immediate casualty is likely to be Hong Kong, which historically served as the entrepot for 99% of China's silver exports. With the new licensing regime, the flow into Hong Kong vaults is expected to slow dramatically, creating a liquidity trap for the LBMA system, which relies on Asian flows to balance deficits in London. This liquidity trap is not a theoretical exercise for the distant future. It is the immediate operational reality of the global silver market, as of this very morning. The Ministry of Commerce in Beijing has effectively placed approximately 60 to 70% of the world's refined silver processing capacity behind a regulatory firewall, and they did it with a surgical precision that Western industrial consumers are completely unprepared to navigate. This is the structural weaponization of silver. By replacing the previous export management system with a rigorous licensing regime, every single shipment of silver exiting mainland China now requires a specific government-issued license. The era of the broader volume-based quota system is over. That system allowed for a relatively fluid movement of metal across borders, but its replacement introduces a level of approval friction that acts as a literal kill switch for the international supply chain. If Chinese domestic solar manufacturers or high-tech firms face even a minor shortage, the Ministry of Commerce can and will simply pause the issuance of these licenses. This traps the metal within the Chinese domestic market regardless of how high the international spot prices on the COMEX or the LBMA might climb. Effectively, the People's Republic of China has transformed its massive silver supply from a global resource into a domestic strategic reserve. While the official communiques coming out of Beijing cite resource protection and national security as the primary drivers, the timing is anything but coincidental. It coincides perfectly with the global explosion in demand for TOPCon solar cells and artificial intelligence hardware. This is a mercantilist strategy designed to secure low-cost silver for Chinese manufacturers while starving their international competitors, cementing China's dominance in the green energy and high-tech sectors for decades to come. On December 30, 2025, the Ministry of Commerce released the definitive List of 44, which identifies the only entities authorized to export silver for the 2026 to 2027 period. This list is a masterclass in the consolidation of power. Despite the booming global market and the record high premiums we are seeing in Shanghai, the list was restricted to only 44 companies, an increase of only 2 from the previous year. This deliberate restriction has effectively excluded smaller trading houses and independent arbitrageurs from the market. The global supply is now held in the hands of a cartel of large, state-owned enterprises and major mining conglomerates. One of the primary gatekeepers on this list is Jiangxi Copper, one of the largest integrated copper and precious metals producers in the world. Their internal compliance documents have already indicated a strict adherence to the new London Bullion Market Association Responsible Silver Guide, suggesting that their export decisions will be tightly aligned with state directives, rather than purely profit-driven arbitrage. Then you have Zijin Mining, a global giant with significant copper and gold assets across Africa and Europe. As a key license holder, Zijin acts as the primary conduit for Chinese metal to the rest of the world. However, its strategic importance has already put it in the crosshairs of geopolitical tensions, with United States lawmakers scrutinizing its operations. Other state-linked producers on the list, such as Yunnan Copper and the Tongling Non-Ferrous Metals Group, reinforce the state's absolute grip on the flow of the metal. Baiyin Non-Ferrous Group, another critical entity, has also been formally designated as a gatekeeper. For international industrial buyers, the implication of this list of 44 is stark. They can no longer source silver from a diverse array of suppliers or count on the open market to fill gaps in their supply chains. They must now negotiate directly with a state-approved cartel of 44 entities. This gives Beijing immense direct leverage over both the pricing and the physical availability of silver. Market commentators are rightly drawing parallels between this current silver policy and the 2010 rare earths crisis, during which China restricted exports of critical elements like neodymium, sending global prices into a vertical spike. This rare earths moment for silver uses export licenses and a white list of approved exporters to control flow and favor domestic industry. However, there's a fundamental difference. Silver is a monetary asset. Restricting its flow impacts global financial liquidity, not just industrial supply chains, which is why the spread between the Western paper markets and the Shanghai premiums has widened to such an extreme degree. The immediate casualty of this policy is the city of Hong Kong, which historically served as the entrepot for 99% of China's silver exports. With the new licensing regime now in effect, the flow of metal into Hong Kong vaults is expected to slow to a trickle. This creates a lethal liquidity trap for the LBMA system in London, which has historically relied on these Asian flows to balance its own structural deficits. A vault drain in Hong Kong is now anticipated throughout the first quarter of 2026, further tightening a global market that is already struggling with a structural supply deficit. The physics of this deficit are undeniable, and they are occurring against a backdrop of a fundamental break in the silver market's equation. Mine supply is stagnant, but industrial demand has undergone a step change function due to technological shifts that are no longer speculative. The solar industry remains the single largest driver of industrial silver demand, and a technological transition within this sector is currently accelerating consumption beyond all previous forecasts. The industry is aggressively moving away from the older PERC, or passivated emitter and rear cell technology, and toward N-type cells, specifically TOPCon, or tunnel oxide passivated contact, and heterojunction, or HJT cells. The math here is brutal for the paper shorts. TOPCon cells are approximately 50% more silver intensive than the PERC cells they are replacing. They require silver paste on both the front and rear sides of the wafer to achieve the higher efficiency rates required for modern utility scale projects. HJT cells are even more demanding, often requiring low temperature silver pastes that are less conductive, which necessitates even higher volumes of the metal to achieve the same performance levels. For years, analysts predicted that thrifting the process of using less silver per cell would offset the growth in solar installations. However, in 2026, the physics of thrifting have hit a hard wall. Efforts to replace silver with copper have faced massive reliability issues, particularly regarding long-term oxidation, which leads to catastrophic panel failure. Manufacturers are finding that to achieve efficiency rates of 24% and higher, they must use high-load silver pastes. The silver tax on solar is now a non-negotiable cost of doing business. Because China produces over 80% of the world's solar panels, their domestic export controls ensure that Chinese solar manufacturers, and not their competitors in India or the West, have priority access to this critical input. But the solar sector is no longer the only black hole for silver supply. A newer and even less understood driver is the massive build-out of artificial intelligence infrastructure. In the high-frequency, high-heat environment of AI data centers, conductivity is king. Silver is the most electrically conductive element on the periodic table, and it is being consumed in record quantities to power the AI hardware stack. Silver is used extensively in multi-layer ceramic capacitors, or MLCCs, which regulate power flow on complex motherboards. A single AI server rack can contain tens of thousands of these MLCCs, each containing microscopic layers of silver. Furthermore, the high-speed data transmission required between GPU clusters demands silver-plated connectors and interposers to minimize latency and ensure signal integrity. With the AI arms race accelerating into 2026, the demand for these high-performance components is effectively price inelastic. Data center operators like Microsoft and Google will pay whatever is necessary for silver components to ensure their $100,000 GPU clusters function correctly. While this demand is soaring, the global supply remains in a structural straitjacket. Approximately 80% of global silver supply comes as a byproduct of lead, zinc, and copper mining. This means that silver supply is almost entirely inelastic to the price of silver itself. If zinc prices fall due to a global construction slowdown, zinc mines close, and silver production drops even if silver prices are skyrocketing toward triple digits. The situation in major producing regions like Mexico and Peru is deteriorating. Mexico, the world's largest producer, is grappling with declining ore grades and a hostile regulatory environment for mining. Peru continues to face social unrest and community blockades at major byproduct mines. The vault drain is quantifiable. Inventories at the Shanghai Futures Exchange have hit a 10-year low, and registered inventories on the COMEX have plummeted by nearly 70% since 2020. The cushion that once protected the market from price spikes is effectively gone. My name is Kevin Huang, and here at Markets. In context, we are tracking these physical dislocations in real time to ensure you are positioned for this shift. If you want to understand the true nature of this shortage and receive continuous updates on the list of 44, make sure you subscribe to the channel and turn on the notification bell. As of January 1, 2026, the global financial institutions and analysts are deeply divided on the trajectory of the metal. This divergence in forecasts reflects a broader disagreement about the direction of the global economy: recession versus reflation. The bullish camp focuses on the physical deficit and the strategic nature of the metal. Citigroup maintains a highly aggressive target of $110 per ounce by the second half of 2026. Their thesis is predicated on the China factor specifically, that the new export controls will starve the Western market, forcing a massive repricing to attract metal back to London and New York. Goldman Sachs is also in the bullish camp, projecting an average price of $85 to $100 per ounce. They frame silver as the indispensable metal of the green transition. arguing that the solar and AI demand vectors are secular, not cyclical, trends. This institutional bullishness is mirrored by retail sentiment, where polls indicate that nearly 60% of retail investors expect prices to breach the $100 mark. This collective optimism is fueled by influencers like Robert Kiyosaki, who has issued a bold $200 price target, citing a complete collapse of trust in fiat currencies as a primary driver. At the same time, the conservative or bearish camp, led by JP Morgan, is betting on a global recession to bail them out of their current situation. They forecast a significantly lower average of $56 per ounce for 2026, citing a 35% probability of a U.S. and global recession. In a recessionary environment, industrial demand typically contracts, and they anticipate that high prices will eventually trigger demand destruction, forcing manufacturers to find alternatives to silver. However, precious metals houses like Heraeus warn of headwinds in the first quarter of 2026, noting that high prices are already crushing jewelry and silverware demand in price-sensitive markets like India. If the industrial narrative falters, the loss of this jewelry baseload demand could lead to a temporary price correction. Yet, Saxo Bank offers a distinct perspective with its quantum shock scenario, positing that a breakthrough in quantum computing could render current encryption obsolete, causing capital to flee digital assets and flood into physical safe havens like silver. Rumors of a massive 8 banks short position have also circulated, but regulatory data from the Commodity Futures Trading Commission provides a more nuanced view. The official bank participation report indicates that the net short position is held by 22 banks, not 8, and while it is substantial and a potential source of a short squeeze, it does not currently point to an imminent banking collapse. As the first day of 2026 closes, it is clear that the tug of war between the paper market shorts and the physical demand is reaching a breaking point, and the macro environment is only adding more fuel to the fire as the Federal Reserve pivots to an easing cycle that will likely push real yields deeper into negative territory. This occurs as the United States dollar faces its own structural headwinds, with long-term currency debasement and expanding fiscal deficits acting as a mechanical lever for silver prices. The consensus for 2026 is explicitly bearish on the dollar index, which historically correlates with explosive moves in the silver price when real yields are falling. The combination of industrial necessity and monetary desperation is creating a scenario where the price on the screen becomes irrelevant compared to the actual availability of the metal. As the sun sets on January 1, 2026, the silver market has fundamentally changed. The price on the screen is $71.26, tells only a fraction of the story. The real story is the $10 premium in Shanghai, the list of 44 exporters in Beijing, and the emptying vaults in London and New York. Bifurcation is real. We are witnessing the bifurcation of the global silver market into a Western paper market and an Eastern physical market. The arbitrage that once bound them together has been severed by export controls. The combination of low inventories, high leverage, and geopolitical maneuvering guarantees that 2026 will be a year of violent price swings. The industrial floor for silver has risen. Solar and AI demand are not going away. The structural demand creates a put option under the price, limiting downside risk even in a recessionary environment. With the new export licensing regime, China has successfully asserted sovereignty over the silver supply chain. Western manufacturers of solar panels and electronics now face a new reality. Their most critical input is subject to the strategic whims of a geopolitical rival. In 2026, silver is no longer just poor man's gold. It is a strategic energy metal, a geopolitical pawn, and a monetary escape valve, all wrapped in a single volatile package. Thank you for joining me for this exhaustive start of the year analysis. This has been Kevin Huang for Markets in Context, and I will continue to keep you updated as this historic silver squeeze unfolds.